Good evening, everyone, and welcome to this Market Insight webinar. In this monthly series of webinars, we endeavor to cover some of the key macro and economic trends, deep dive on equity market valuations, and discuss on one of our investment strategies, which may be of your interest. I am Niranjan. With me today, our Chief Investment Officer, Mr. Vetri Subramaniam, and Fund Manager, Vishal Chopra. Vishal is Fund Manager for our UTI Focused Fund, UTI ELSS Tax Saver Fund, and also UTI's Children's Equity Fund, which is having a legacy of more than 30 years. And he manages over 8,000 crores of assets among these three schemes. Vishal shall today briefly take us through on the long-term performance and fundamental track record of companies with varied return profile. And he will also discuss on his investment strategy that he adopts in UTI Focus Fund, which is he going to talk in detail today. Before Vishal actually takes over, I will first now hand it over to Mr. Vetri Subramaniam, our CIO, for his initial remarks. Thanks, and over to you, sir.
Good evening. Thank you, Niranjan, and thank you everybody for joining us here on today's Equity Market Insight, which is the monthly webinar that we do. And delighted to have Vishal here with me. He'll be talking about the Focused Fund. He's been an invaluable member of the team for nearly 13 years now, so it's a lucky 13 for him. And he's been a fund manager now for a little close to 6 years actually. So he's got a fair amount of experience as an analyst looking at a diverse range of sectors, and now as a fund manager. So as usual, what we'll do is I will kick off with the presentation, which has been put together by Niranjan, and this covers, as we normally do, different parts of the market. And as you can notice, my current look is slightly different from the look on that deck, but nothing else has changed. So we'll just keep going with the slide. So Niranjan, we can move on to the first slide. Great. So, we got the print for quarterly GDP. This is for the quarter ended June. And this was slightly softer than what people were expecting. Remember, the RBI is expecting 7.2% growth for the full year, which is financial 25. This quarter came in at 6.7, slightly lower than analyst estimates. But the RBI governor has been talking about the fact that they still think 7.2% is well within reach. But today I'm not going to talk about that. What I actually wanted to highlight here is to show you the real GDP curve, which is that purple line. And you can also see that orangish yellow line, which is the nominal GDP. Now you can see over there, at the beginning of this chart, 2019, you can see the values there. Real GDP was at 5%, nominal GDP at 8.5%. Then we saw that massive slump into the June quarter of 2020 due to the pandemic, and simultaneously a sharp recovery into 2021. Again, another bump in 2022 because that was associated with sort of the second, with the 1-year anniversary of the second, sort of wave of COVID, which spread in India. And the main thing you can notice there is that there is a very big gap between the yellow line and the purple line, which in essence reflects the contribution of inflation. And by the time you move to 23, the gap starts to vanish and comes down. This is also in line with inflation numbers that you'll see later. But you can see that in general, now the gap is much smaller between real and nominal GDP. But the one point that I would want to make is that nominal GDP of late has tended to stay below 10%. This has typically not been the norm for India because in the past, even at 6 to 7% real GDP growth, we typically had much higher inflation, and as a result, we were more used to nominal growth in GDP being in the double-digit number. But in recent times, we've seen that it tends to stay just below 10%. So when you think about what is India's economic growth potential, particularly when we think about numbers which are related to corporate revenues and profits, remember these are related to nominal growth and not to real growth. So now we need to think about the nominal growth of the economy as being about a 10% level. And if growth is going to be at that level, then everything else, including profits and returns from different asset classes, get anchored to that number. So this number is slightly and qualitatively different from what we used to see in the past. Moving on to the next slide. This shows you a deep dive into the inflation numbers. And as you can see on the left-hand side, there is CPI, which is the black line. And then you've got food inflation, which is the very violent, reddish-orange line. And the yellow line is core CPI. The latest print of CPI was well within the RBI's comfort zone. It's even below the 4% target at 3.5%. But the reason for this really was a massive collapse in year-on-year inflation, because last year at this point of time, the year-on-year jump in inflation was very high. There was a base effect, therefore, which has caused this number to come down. But the main point that I will make is that inflation appears well contained. RBI's 4% target may still prove to be slightly challenging. RBI's own forecast is average inflation closer to 4.5% for the full year. But the good news is that core inflation is 3.4%. But I would also say we need to watch that core inflation number of 3.4% carefully, because if monetary policy remains in its current stance, which is withdrawal of accommodation and an excessive focus on curtailing liquidity, then you run the risk that eventually not only is that core inflation number may actually be reflective of a slowdown in growth as well. So I think we are now in territory where the MPC and the RBI will have to be slightly more careful about their next few steps, because core inflation is clearly indicating that things in the economy are very well contained outside of food inflation, and an attempt to pull down the headline inflation number further might actually be negative in terms of its impact on growth. The good news for India on the right-hand side, now the contribution of Brent crude to CPI directly is now very limited. Crude has a much bigger contribution in wholesale inflation than it has in CPI. But the good news for India is that oil prices have remained very well contained now for pretty much the last year, little more than a year, and therefore this does not look to be a significant factor in gauging the outlook for inflation. And despite the ratcheting it up of tensions in the Middle East since October 2023, crude has largely tended to stay in a very tight band, and if anything, it's actually showing signs of breaking down lower rather than going up. So I think that's good news from India's point of view. Quickly moving on to the next slide. I talked about this earlier, and this has a lot of talk going on about the tightness in the banking system. A lot of commentary being written about, loans are growing faster than deposits. And of course, the loan to deposit ratio that you see on the left-hand side, and this is almost like a 20+ year chart. Without doubt, the loan to deposit ratio is elevated in the current environment. But to be very clear, this has nothing to do with Indians choosing to invest more in mutual funds, or for that matter in equities, because even if they invest over there, that money stays within the banking system. They may be buying equities, but somebody is selling equities, and therefore money stays in the banking system. And all trades that you do in the market are eventually settled within the banking system. So really, more people investing in financial assets other than bank deposits has no impact on bank deposits, except the nature of bank deposits and liquidity might change, because people move more towards or because the liquidity in the banking system would then be held in current accounts rather than being held in term deposits. So that's the only impact which happens when more money moves towards non-financial assets, excluding bank deposits, but it doesn't really impact deposits directly. The biggest contributor to the tightness is actually RBI directed, because RBI created money. Now, M3, without getting into jargon, is the widest definition that we have of money supply. Who is a very significant contributor to money supply? It is the RBI. In times, they have accounted for as much as 20 to 23% of total money supply is the money created by RBI. Currently, they are running well below trend. They are running at just about 18% of total M3 being contributed by RBI created money. And remember, this RBI created money is a reflection also of RBI's own thought process, which is withdrawal of accommodation. So in a way, we think these two are actually linked, and therefore some of the tightness that you see in the banking system reflects RBI's conscious choices, may be driven by the inflation targeting methodology that they have, but they are keeping liquidity tight. And we do believe that as they start to see growth come under pressure, or for that matter, they see inflation well within the comfort zone, they will start to think differently about the liquidity that they are creating. And this should help the system liquidity start to balance itself much better. So that's sort of the opening backdrop I wanted to provide in terms of macro. But we'll quickly move now on to the next few slides where we talk about equity markets and valuations. First off, we look at EPS growth. The current expectation for March 2025 is about 13% EPS growth, going up roughly to a nifty EPS of about 1100. And the estimate for 2026 is about 16% growth. Now, 2026 very far away in the future, but 2025 much closer, 13% growth expected there. Now, again, I will caveat and link this back to the nominal GDP growth number I talked about earlier, which is to say if nominal GDP growth is growing at 10%, revenues expected to grow in line with that, then profit growth of 13% can only come from operating leverage. However, we know that in the last 18 months, profit growth has actually been driven significantly by margin expansion because of a cool off in commodity prices. And therefore, to my mind, 13% is not a high bar, but neither is it a low bar, because it will require profits to grow faster than nominal growth in the economy, which is never an easy thing to do at an aggregate level. So that's something to keep in mind. Moving on to the next slide, this just shows you the trend in earnings estimates. If you go back to June 23, the expectation was that earnings for March 2025 would be 1119 rupees. That has come down by about 1% to 1109. But still, I would say largely a flat line, no dramatic collapse. In the past, we've typically seen earnings estimates being cut by 4, 5, 6% over the passage of 12 months. This time, it is largely unchanged. And this has been the pattern in India now for almost the last 18 months, where there are no significant earnings cuts. But equally important, there are no significant upgrades coming through to earnings either. You're also seeing March 2026 numbers show an upward trend, but I would not read too much into this upward trend, because typically analysts don't really put out their 2-year forward numbers or 3-year forward numbers. So very likely in December 23, you did not have published estimates for March 2026. And what the numbers here are showing you is just the sort of publication of numbers impacting that numbers, only few brokers or few estimates being available for 2026 when we go back to December 23. So stability in earnings estimates is the message over here. Jumping through to the next slide, where we'll start to talk about valuations. Nothing much to add here, because markets were up in August, so you're seeing that same impact on valuations. Trailing PE multiple of Nifty 50 goes higher. Forward PE multiple of Nifty 50 also goes slightly higher. It's clearly in the expensive zone. What does it look like on price to book? You can see that on the next slide. It is in record expensive territory, at least compared to the last decade. Of course, I would also point to the right side, which is ROE is extremely high. But then again, ROE is cyclical, as you can see. And therefore, having the market priced at a high price to book and a ROE, while it makes sense, it does not reflect what is inherently very often the cyclical structure of the economy. And that is why it is a little bit of a matter of concern at this point of time. What does it look like when we look at the mid cap and small caps? Again, nothing much has changed. both mid cap and small cap, trading more expensive than the large caps, and this has been the pattern for a while now. I continue to be mystified by it, but the message is not how much longer can this continue. The thought process that we would really bring to the table is to say, this is the reality. How do we deal with it? We think we deal with it by focusing more towards large caps, where on a relative basis, there's more comfort, but I'll talk about that later. Going on to the next slide, here we are talking about bonds versus equities. The current yield difference still in territory where fixed income looks favorable. I know most people tell me, oh, what's the point of investing in fixed income? You get only 7.5%. You have to pay full tax. Be that as it may, the spread over inflation is quite attractive. You're getting 7.5% returns, at least YTMs on portfolios, compared to an inflation print of CPI of 3.5%, which is a 300 basis point positive spread. Theory tells you that that is an attractive level. How you can capture it, I would say there are many hybrid strategies in which you could capture this positive yield advantage to your favor if you don't want to go to fixed income funds. So there are ways in which you can do this. Moving on to the next slide, which is just to sum up everything I've been talking about. The US came in at 3.1% growth in second quarter 2024. No sign of any significant slowdown over there. High frequency data is starting to weaken at the margin. So is inflation, and therefore it is setting the stage for rate cuts by the US Fed. But keep in mind, the US Fed's inflation target is 2%. Inflation is still at 2.7%. So the big message that I will continue to reiterate is that we are seeing more normal inflation and a more normal yield curve. We don't think the base case is that we move back to the interest rates of zero, which existed somewhere between 2008 and 2022. We are not going back to that era. In India, GDP growth we've already talked about. The MPC seems inclined to stay on hold based on domestic considerations. But as I said, with core inflation being so low and within the comfort zone, even if you presume inflation stays at that 4.5%, it's pretty close to the RBI's target zone for inflation. And therefore, the question is, how much longer can they continue to hold both stance as withdrawal and the rates in this restrictive territory? Nifty fund consensus, earnings growth we've already talked about. We've talked about valuations. So really, I think the thought process of investors at this point of time should not be so much about when will a correction come, why will it come, how large will it be, how small it will it be a time correction. I've been in the market for 30 years and there has never been any clear answer to this before it actually happens, neither on the downside nor on the upside. The only thing which is within the control of an investor is to react to the factors which are within their control. And I would say one is asset allocation, second is risk management. So please focus on these two, because these are a better, sort of factors to look at to triangulate your investment decisions, rather than to try and speculate about when the market might correct, or for that matter, not correct. So what's the best way to tackle this? Look at hybrid strategies, the balanced advantage, multi-asset, equity savings fund. All of these can be considered for lump sum investments. You can move money away from equity into, for example, the equity savings product, which has only about a 20 to 40% equity allocation, currently closer to 20 than 40. So you will get the benefit of the high carry on your fixed income, and at the same time, a slightly more advantageous tax treatment. In the current environment, one sector that we find favorably placed is really the banking and financial services sector, where valuations are below average, but fundamentals, we would say, are quite healthy. The healthcare sector has been a consistent recommendation that we've been making. But the fact is that sector and fund are up almost about 100% from March 2023. So a lot of the absolute attractiveness is now removed from the sector. There is still some relative attractiveness and defensive nature of the sector, which would keep us positively inclined. But certainly, it is no longer as attractive as it was in March 2023, having literally doubled from that level. Our bias In equities is towards large caps based on relative valuations, but even there we would say stagger your investments over time through a SIP or STP. And finally, the innovation fund has done reasonably well in recent times without going into the actual nitty-gritty of performance. It is a high-risk strategy, but we continue to believe that investors can look at this through the SIP route simply because of the potential for this theme over the next 10 to 15 years. So that's about the key thoughts that I wanted to share with you. I'll pause here and hand over to Vishal, and Vishal will take the next 15 to maximum 20 minutes to run you through his strategy, and then we'll have 20 minutes for Q&A. Over to you, Vishal.
Hi, thanks everyone. Thanks for joining. I'll discuss the UTI Focused Fund strategy. So as the name suggests, it is in the focused category of SEBI classification. It's a concentrated strategy where we are allowed to invest in maximum of 30 stocks, and we manage the fund with a blend of growth and value as an investment style. So what makes the product unique is, as I said, it's a concentrated portfolio. So we have a very wide and experienced research team covering almost 400 stocks. So we try to pick the best 30 ideas from our research coverage. And the good part is that the fund does not have any market cap restriction. So we can look for best ideas across sectors and across market capitalization. So what that does is gives a very unique positioning to the fund in terms of very high active share. If you compare to any of the other diversified strategies, this fund, because of the concentrated nature, will have a very high active share, which means that the fund has the ability to give good alpha to the investors. So before going into the details of the fund strategy, let me take you through some of the few observations which we have across market caps and across the ROC tiers of companies. So just to recap, what we do in UTI is that we classify all the listed companies in 3 buckets based on their return ROC. If the company is generating more than 18% ROC, that is classified as an R1 company. A company generating less than 10% ROC in last 5-year average is classified as R3. And the balance companies between 10 to 18% are classified as R2 company. So if you look at the 1-year returns on the left-hand table, what we'll notice is that in the last 4 years, R3 companies or companies with low ROC, or I would say the companies on the value end of the bucket or low quality bucket, have delivered very strong returns. While if you look at the R1 category of companies, although they have delivered decent absolute returns, they have delivered good absolute returns on a 4-year basis, except FY23, which was a weak year for the market. On a relative basis, obviously they have outperformed. And if you again look at the same thing on a 3-year and 5-year basis, you will notice the same pattern that on a 3-year basis, again, last 3 years, R3 has outperformed R1, while on a 5-year basis, last year, R3 has outperformed R1. Part of it is also due to the fact that it is a low base impact. If you look at on a 1-year basis, before FY21 for 3 years, R3 companies delivered very poor returns. Same way, if you look on a 3-year basis, before FY22 for 3 years, R3 companies delivered weak returns. So it's a combination of obviously a low base returns coming off from a low base, and obviously also in the how the economy has progressed and how the markets have looked at valuations and improving fundamentals. One other thing to highlight is if you look at the 3-year and 5-year returns, R1 companies are generally more consistent in their returns, while R2 and R3 companies are more cyclical. They tend to go through a period of poor returns, then followed by a very strong returns. In fact, if you notice, R1 companies on a 3-year and 5-year basis actually never deliver negative returns, while there are phases where R2 and R3 companies actually deliver negative return even on a 3-year and a 5-year CAGR basis. So basically, the point of this slide is that R1 companies are more stable returns, while R2 and R3 are slightly more cyclical. And in the current phase of market of last 3-4 years, we have seen R3 companies delivering better returns compared to R1 companies. And if you have to do the same analysis on a fundamental basis, basically we have looked at revenue growth, EBITDA growth, PAT growth, and OCF growth. And if you notice the last 3-year average, R3 companies actually have delivered very strong returns, be it EBITDA growth, they have almost delivered 30% EBITDA CAGR, while the OCF CAGR also has been strong at 35%. And they have outperformed basically R1 companies. But when you go to 5-year and 10-year basis, you will see that R1 companies tend to have more steady returns and they tend to deliver returns better than R3, as R3 companies in longer term had delivered weaker returns. Again, this points to the fact that the cycle of last 3 years have been very strong on the fundamental basis also in R3 companies, and that has led to very strong returns by R3 companies. And since they are cyclical in nature, obviously there will be a cycle when R3 companies again underperform both on fundamental and stock returns basis, and R1 companies could do better, which are more steady in nature. The point of the last two slides is that UTI Focused Fund as a strategy tends to follow a blend approach. So we have a core of the portfolio which invests in R1 companies, but we also try to invest in R2 and R3 companies to take advantage of those cyclical nature and cyclical opportunities, as we can come and we can ride the cycle. And obviously we can shift between our portfolio between R1, R2, and R3 as we see valuations and the cyclicality of different sectors. So on this slide, you will see there are 3 buckets. Basically, what we try to do in this fund we follow a blend of growth and value. So to come to that blend, we try to identify opportunities in 3 buckets. And the core of the portfolio are the sustainable businesses, which are largely R1 companies with strong return ratios, companies with good long runway for growth, and companies which we think have a pricing power or ability to gain market share or significant cost advantages, product innovation, network effects. So some bit of strong competitive advantage as well, and they have a good runway for growth. So that is, I would say, the core of the portfolio. On top of that, we try to generate alpha for the investors by betting on one bucket, which is cyclical opportunities. As the name suggests, these are companies which are cyclical in nature, where we think valuations are attractive, and there could be mean reversion both in valuations as well as fundamental performance. I mean, a simple example could be a commodity or a steel company going through a bad phase, and we believe the margins are at cyclically low and the margins can improve, and the valuations also can improve with that, and that we try to take advantage of that cyclical opportunity in that sector. So I would say some bit of portfolio will try to play in that bucket. And last is transformation opportunities, or I would say more of turnaround opportunities. And these are generally companies in which we have good history. Maybe because of some internal or external reasons, they are currently going through a challenging time. And if we feel there are some external or internal triggers could be like change in management, change in CEO, while external triggers could be change in competitive landscape, change in regulations, any other such reasons. And if we believe the company's performance can improve and starting valuations are still very cheap, and we can take advantage of the valuations as improving valuations as well as improving business fundamentals, we will try to identify such companies. So the combination of 3 put together, and as you makes the blend of growth and value. And as you can imagine, what I explained in the earlier slides, the cyclical companies which sit more in the R2 and the R3 bucket, and the steady businesses sit more in the R1 bucket. Based on that, we try to take advantage of the cyclical opportunities which we continue to find in R3 companies. So, but what is equally important in this fund, as we are taking very concentrated bets, the weight in each stock is much higher than in any other diversified fund, as we are supposed to invest in only 30 stocks. So what is important is what are the exclusion filters we apply for this fund. Starting from the right hand side, the inferior ROC and the inconsistent cash flow flows from the score alpha framework which we have at the UTI at the research level, where if through a cycle, if we believe the company is unable to generate cash flows and ROC, obviously we'll try to avoid those kind of companies. The balance 3, if you look at management issues in terms of corporate governance, any issues with how they treat minority shareholders, companies where we feel the leverage is too high, or in businesses where we think the long-term sustainability can be questioned, I think we avoid all these companies because they could lead to a permanent loss of capital. So these are a few of the exclusion filters we try to apply when we look at investing in companies. Specifically, I would say for cyclical companies, leverage factor becomes very important, because if the cycle doesn't play out in our favor, and if the company has very high leverage, that could actually lead to bankruptcy risk, which is a permanent loss of capital for the investor. So these are some of the things we try to avoid while investing in all the companies. What I'll try to do very quickly is that I'll give few examples of the three buckets which I already explained. I mean, a lot of it is self-explanatory. All the companies are very well known, and most of these companies are also part of our current portfolio. So on the sustainable businesses slide, if you look at the two companies example which we have taken, one is Trent Limited, which is in the apparel retailing. It runs two large formats, Westside and Zudio, and then Bajaj Finance, again, NBFC, well known, more on the unsecured credit side. What we have seen over last 10 years, last decade, is a very strong growth in both revenue and AUM by both the companies, and we have seen consistent improvement in the return ratios, and which has obviously translated into very strong shareholder wealth, because both in terms of earnings growth and also in terms of valuation multiple continuing to re-rate. On the cyclical opportunity side, if you first example is Tata Steel, which I already alluded to while explaining cyclical opportunities. I mean, here if I have to point out, say somewhere in FY22, we saw metal prices correcting and stock seeing good valuation correction, but we were seeing the company was able to deleverage and debt had significantly gone down, and we believed that the profitability could improve and valuations could also improve. So we took a bet, and obviously from that point in time, the stock has delivered good. We know that in FY16, when Jio entered, the sector had a average revenue per user, or ARPU as we call it, of close to 200 rupees. After that, there was a massive competition in the sector, and ARPUs all the way dropped to closer to 120 rupees, which meant margins also collapsed. You can see from the bottom left chart, margins from upwards of 40% fell to almost 20%. After that, we saw a massive consolidation in the sector. We believe because of this excessive competition, where there were 7-8 players in the sector, we ended up with only 3 players. And after that, we have already seen 3 rounds of tariff hikes, which led to both ARPU improvement and margin improvement, and now good free cash flow generation also, and which is reflected in the stock price. First, it corrected after Jio's entry, and now over last 3-4 years, it has generated very strong returns. And last example on turnaround side is Tata Motors. Somewhere around pre-COVID, the company was struggling both in India business, where the market share had fallen to single-digit levels, and average was very high, as JLR was also struggling. After that, we saw company introducing multiple models in the domestic business, leading to market share improvement. JLR also, they worked on costs in JLR, which led to debt reduction, and we have seen stock doing well. One of the things I want to point out in this specifically in this bucket is that we try to continuously keep on continuously identifying this kind of opportunities. And once the turnaround plays out, then we take a fresh look at the company. Some of the times the turnaround companies end up becoming the sustainable business companies, so continue to hold on. Some of the times we feel the turnaround has played out and maybe the company is still cyclical in nature, and we try to exit and look for new opportunities. Case in point here, Tata Motors. I mean, you will see in the slide, like Tata Motors we had for a long time, and then since the fund inception, and now because the turnaround has largely played out, we have exited this stock. And obviously, like this, we'll continue to evaluate more turnaround opportunities for the portfolio. The other thing, because this fund has moderate churn, and we continuously try to find out opportunities and also play across market caps. One of the things, I mean, which Vetri also explained in his presentation on valuation between large, mid, and small. If you look at when the fund was launched, the fund almost had around 65% of allocation to large cap and 35% to mid and small cap. Now, increasingly, we find more comfort in large cap valuations compared to mid and small cap. So we have now increased our large cap allocation to close to 80%. While mid and small cap allocation is close to 20%. So this is our view today. But obviously, if 1 year or 2 years out, there's a correction in mid and small caps, and if we find valuations again attractive in mid and small cap, we can obviously again tilt the portfolio more towards mid and small cap compared to large cap. So that is the benefit of having a flexibility to invest across market caps. And lastly, linking again the point to the R1, R2, R3 discussion we had, if you look at the top right chart, which is for the focused fund, the breakup between R1, R2, R3, if you see when the fund got launched, the fund had almost 70% weight in R1 companies. And as the market had seen a correction and we saw more opportunities in R2, R3 companies, we actually reduced our R1 exposure and increased our R2, R3 exposure. But now in last few quarters, we again believe R1 companies are more fairly valued after the sharp outperformance of R2, R3 companies. Actually, we have again increased our R1 exposure to almost 65%, while 35% of the portfolio is in R2 and R3. Against that, if you look at the benchmark, which is bottom right, only 50% of the benchmark is in R1, while 50% is in R2 and R3. In fact, R1 exposure in benchmark has actually went down. It's also mainly because of the outperformance of R2 and R3 companies, so their weights have got increased. In terms of sectoral movement in last 1 year, what we have majorly done, I'll highlight few of the major changes which we have done. Largest, I think I would say, is auto and auto component sector. We had a large overweight in the sector, but as the sector has seen strong outperformance over the last 2-3 years, and now valuations have become fair. So we have actually gone from an overweight position to a underweight position in the sector. The second big change I would say will be in the consumer services sector. We were always overweight the sector, but the sector actually was seeing underperformance till around 6 to 9 months back, as there was a weak consumer sentiment and the demand and we were seeing demand weakness across a lot of retail sectors. And we saw opportunity valuations were also fair, so we increased our weight. Over last 6 months, we have seen this sector continue to do well, and that's why both because of actively buying and both because of the passive nature, because of the valuation, because of the sector doing well, actually our overweight in the sector has further gone up. The other key sector I would say will be IT. We were almost neutral a year back, but as we saw valuations more comforting and demand also improving, we have actually become marginal overweight on the sector now. Oil and gas sector, if you look at it, till a year back, we had zero exposure to that sector, but we have added Reliance to the portfolio, and that's why the underweight on the sector has gone down. But still, we continue to remain a massive underweight on the sector. And lastly, if you look at the real estate sector, we had a big overweight on the sector. We are still overweight, but as the sector has done well and valuations have become expensive, we have done profit booking and reduced our overweight exposure on the sector. These are some of the stock specific changes we have done. I will not go into each and every change we have done. What I'll just like to highlight is that as I said, because it's a concentrated portfolio, we can own only 30 stocks. So every time we get a better idea and we want to own one name in the portfolio, it compulsorily means we have to exit one existing idea, because the number of names are limited. We can't increase the number of stocks in the portfolio. That is why whenever we are continuously searching for good ideas, and whenever we find a good idea, we replace it with an existing idea. So this fund has moderate churn, and you will continue to see this kind of movement in the portfolio as we try to keep finding ideas across the 3 buckets of sustainable business, cyclical opportunities, and turnaround opportunities in the portfolio. This is the portfolio as of August end, week old. So I mean, we can have a look at it. I think we can keep the slide here for a few seconds and then we can open up for questions. Thank you.
Yeah, sure. Thanks, Vishal. Thanks for a detailed overview on UTI Focused Fund. So yes, now I would request our viewers to queries on the chat box. So we'll be more than happy to take them in the next 15-20 minutes or so. Right. So here is the first question to you, Vishal. So when it comes to the portfolio construction of UTI Focused Fund. So would you take any view at sectoral level, or is it totally stock specific, or is it blend of both top down and bottom up?
Niranjan, I would say the focused fund is more of a combination of both top down and bottom up investment. So obviously we continue to look for bottom up ideas across sectors, but because we are trying to find ideas across the three buckets of sustainable business, cyclical opportunities, and turnaround, we tend to have exposure across sectors, which we even saw some time back. And because we have to follow a blend approach, which is a blend of growth and value, we try avoid taking any significant deviation in any sector, because if we try to significantly deviate from any large sector, from the benchmark in any of the sectors, I think we will then will become more closer to either a value or a quality growth style. And because we want the fund to remain in a blend approach, we have exposure across sectors. So to answer your question, actually it's a mix of both top down and bottom up approach.
Sure. Thanks. Patrick, there is a question to you. So, if the interest rates are likely to go down across the global economies, right, and also your US Fed has indicated that very soon they will also start cutting the rate. So, from here on, so could there be a significant shift in global financial landscape, like emerging markets, especially India?
Sure. So I think two things to keep in mind. Obviously, over the last 2 years, simply because the hurdle rate for any investor has moved up so significantly because the US was holding the policy rate up very high. Effectively, in a sense, this was pro-dollar. This was, attracting money back into debt. And if the US starts to see rate cuts, then obviously this would make flows of capital out of the US more likely, just relative to the current trajectory, not necessarily reversal. And at the same time, you could expect some more money to flow into emerging markets. But just two things to keep in mind, Niranjan. One is we're not talking about a complete collapse in the rates. We are just talking about rates normalizing in the US, keeping in mind a 2% inflation trajectory and appropriate monetary policy rate relative to that. We are not talking about a return to the pre-2021 period when rates were close to zero. So don't expect the decline to be so dramatic. Second point to keep in mind is that certainly I think flows would improve to emerging markets. But I think one of the things we need to be a little careful about is that India and US, when it comes to equity valuations, are among the two costliest equity markets in the world. So it is not very clear to me that rates coming down would naturally cause investors to look at these two markets, because these two markets are already pricing in fairly strong growth expectations. But if the question is, can money flow into emerging markets in general? I think the answer to that is yes. But I would feel India would be at a slight disadvantage because cyclically challenged economies, where equity markets may be slightly cheaper, as well as bonds, which may not be as well supported as Indian bonds have been, because we've been anyway getting inflows on account of bond inclusion now for quite a few months. Those markets may be bigger beneficiaries. But in principle, yes, easier rates should cause capital flows into emerging markets, but perhaps more cyclically challenged emerging markets would be bigger beneficiaries. India anyway standing alone compared to most of the emerging markets, simply because our macro factors are in such good health.
Sure. Thanks, Patrick. So there is a follow-up question on the similar lines. As investors have actually grown increasingly positive on India's long-term economic growth potential, valuations too have reached new milestones, right? So while there are concerns of earnings growth moderating in the some of the pockets, there are also visibility of global factors and likely to hurt the market sentiment as well. So is there any headwinds from the particularly global side which is going to hurt the market sentiment?
Many different questions there, Niranjan. So, well, as far as headwinds in the macro are concerned, let's face it, the world is not pulling together as one at this point of time. China is on the verge of outright deflation, so they have a serious problem. World's second largest economy. Europe still not showing any great signs of growth, though they're doing slightly better than the worst case expectations maybe people had a few months ago, and certainly at the peak of, or rather at the outbreak of the Ukraine conflict, people thought Europe could do much worse. It's done better than that. But therefore, two large growth dynamos in the world are actually not exhibiting any great optimism. It's only the US which has been extremely robust, and of course, India, much smaller contributor to global growth, but growth numbers have been very, very robust. So really, I think the global scenario is not a very clear one. And remember, we are facing for the first time in maybe 30 years the headwinds from fragmentation of markets, national security taking precedence over free trade, and reshoring, nearshoring, threats of tariffs being imposed. So I would say this is not a very good environment from a global perspective at this point of time. India's macro remains quite good health, but keep in mind two things. And I made this point in my opening comments. If India is a nominal growth economy, 10%, 11%, and you can expect earnings in the long term to grow in line or maybe at best slightly marginally better, but not much higher, then you have to question the fact that is the market in aggregate capturing this growth potential, or has it already captured this growth potential? If it has already captured this growth potential and moved valuations higher, then forward returns from equity markets have to come down. This is very different from saying India's growth prospects have to come down. Let me be very clear. India's growth prospects need not come down over the next decade. India may continue to grow at 6.5%, 7%. Nominal growth may remain 10 to 11%, but the higher valuations have brought future returns into the present, and therefore it raises the risk that future returns may be lower than what people have experienced in the last 3 to 4 years. So that is the thing that investors need to focus on, because you make money from stock price returns, which add to your wealth creation, not from growth in the economy. Some of that may already have been captured in the price that you're paying for equities today.
Yeah. Thanks, Viti. That is really an interesting insight. Vishal, there is a question on the Focused Fund. So the portfolio churn of the fund has been moderately low, not very low, in the range of like 25-30%. So is this, don't you think the question is primarily, is this a very low churn? The portfolio's approach is being very concentrated. Can the portfolio churn be very high? So what's your thoughts?
No, we don't target any specific churn ratio as such, but I would tend to agree that the current portfolio churn of 23% can be as we get, and anytime we get an idea, it necessarily means we have to take out another idea which is already in the portfolio. So I would say the churn can be sometimes very episodic in nature. There could be a few months when we are happy with the current portfolio and we are obviously increasing or decreasing exposure within the existing portfolio, then the churn will be low. If we find good new ideas, say a couple of new ideas, then we have to exit a couple of ideas and enter a couple of ideas, then obviously in that period the churn increases. But overall, I would say the churn can actually go up from the current levels. What exactly, how much, I think I would say it's difficult to say.
Just to add to what Vishal said, first of all, we never have a target for portfolio turnover. It's a function of how the market behaves and obviously how our stock picks behave, and it's always a balance between churning the portfolio too aggressively, which only guarantees you cost but not returns, and showing the patience to remain invested in good companies for long periods of time to realize returns. But there is no target that we have for portfolio churn, either in the focused fund or for that matter other strategies. There is a certain pattern you will notice when you look at their turnover over many years, and that is the pattern that we would look to sort of stick to.
Sure. Yeah, thanks. There's a question on banking sector. So Vishal, so valuation in the banking sector is reasonable. However, there are some uncertainties hanging over that could have a toll on the bank's profitability. on account of falling deposit ratio, or it could be change in the guidelines with respect to the liquidity coverage ratio, etc. Right? So, what are the headwinds that you are actually tracking, and also that could actually impact the bank's profitability?
See, I think couple of headwinds you only mentioned in the question. One is the one is the LDR ratio. So that could actually, in the near term, as till the time deposit growth picks up, could impact some bit of growth in the near term. Second is the LCR norm, which you alluded to, which means banks might have to keep slightly higher liquidity, impacting margins. And third, obviously, again, which you did not mention again, but then a lot of people are talking about what will happen if RBI starts cutting rates, whether what could do margins, especially with banks which have a higher floating rate book. First of all, I would say that all of these factors are obviously cyclical factors and not structural concerns as such. And secondly, I would say that I mean, as you already alluded to again in valuations, is that most part of, I think, concerns are very well known and already reflected in the valuations. I think this is one of the few sectors where valuations are still at discount to historic levels, historic averages. So I would say most of these concerns are very well known and already factored in the valuations of the sector. What we are doing specifically in the fund is that if you have to tackle this situation, I think either you have to focus on banks which have a very strong liability franchise so that they are able to garner deposits at competitive rates because of their franchise, or you try to bet on companies which you think have on the asset side a book which gives them a pricing power or pricing advantage, so that even if there's a cost increase, they are able to pass on the cost to their customers. So that's what we have tried to build a portfolio around, either having a strength around the liability side or a strength around the asset side.
Yes, the PSU banks have actually performed reasonably, relatively well compared to the private banks. So, where is your focus currently today? So, do you have a blend? Are you bullish on any particular space there?
See, I mean, I don't think I have any broad framework versus of PSU versus private. So if you look at the portfolio, we have PSU companies like Bharat Electronics and NTPC in our portfolio. But specific to banking sector, I would say is that if you look at any time period or long-term data, we have seen private sector banks executing better and gaining market share from public sector companies. The growth has been better, the execution has been better, return ratios, ROA, ROE have been better. Obviously, there was a point in time when PSU banks valuations were very cheap, and cyclically their ROAs improved as they came out of a good credit crisis, and obviously the stocks have done well. But from a more longer term structural basis, I think we will continue to prefer private sector banks over PSU banks.
All right. So I think in the interest of time, we will take last two questions for this evening, right? So this is a question to you, Vetri. So the government has actually laid out an ambitious plan for goods exports, right? And this number to hit 1 trillion by 2020, right? On this backdrop, which are the sectors you think are likely to drive growth, and what are the competitive advantage that could help in sustaining their growth?
So I think, Niranjan, the main thing to keep in mind is that export competitiveness is eventually a function of the competitiveness of individual businesses, right? In 1999, nobody could have forecast that by 2024, India's exports of IT services will be more than the value of oil that we import, right? Now, nobody gave a target for this and achieve for the subsequent 20 or 25 years. So, I would say as a nation, it is good that we are setting out such targets. They are aspirational in nature, but eventually they are a function of corporate competitiveness and the willingness of other partner countries to absorb such large quantities of, exports from you. Truth be told, China's net exports today are just about $1 trillion. So when you talk about reaching these kind of numbers, you have to sort of reality test it relative to what is possible. I think to my mind, we can certainly increase our share of exports as a percentage of GDP. We can certainly raise our share of merchandise trade globally, because it's very low. But at the same time, I think India's growth prospects in the medium to long term will be more a function of domestic growth. And my investment thought process for sure is not determined by these pronouncements over what may happen over a 10-year or a 15-year period, because we have seen how targets keep getting reset.
Yeah, sure. Thanks a lot, Vetri. So one last question to you, Vishal. So India faces challenges in terms of job creation and more inclusive economic growth, right? So these issues have affected the real wages, therefore impacting the household consumption among the lower income groups in the recent past, right? While the premium segment continues to be reasonably well placed. So is this trend likely to be a short term, or is this also going to curb the outlook for the private consumption for a long period of time?
So I think what we have witnessed in last few years, especially I would say post-COVID, has been what is more widely known as a K-shaped recovery and wages during COVID period. And they were also better prepared to face the impact of very high inflation, which we saw for at least a year, because obviously they have good savings as well and the disposable incomes are higher. The lower income population, on the other hand, got impacted on both sides. They saw impact on their wages due to COVID, and also because they have anyways have lower savings and lower disposable income, it got hit when the inflation was very high, which is clearly visible in the I mean we can further add the wealth effect impact, because the upper income households also invest in real estate, gold, equity markets, which also saw good returns. So combined all these factors, obviously what you alluded to, the upper end of the households, the premium segments doing well, while the lower end population, while the lower end categories continuing to struggle. I would say what we are now seeing is that at least on both the points of wages and high inflation, we are seeing some stability, at least for now, some period of time, at least more than a year, which will mean the lower income household will see some stability in their disposable income, and slowly and gradually it will improve. At the same time, we are now seeing more and more state governments and even central government more and more realizing this issue, and they are focused on driving rural wages. So I think combination of all this should lead to an improvement in consumption at the lower set of things are already visible, especially if you look at the two-wheeler sales data for last few quarters. You are already seeing an improvement. In fact, four-wheeler sales are seeing slowdown while two-wheeler sales are improving. Some bit of it is also because of low base effect, but we are directionally seeing the lower end doing better, while the upper end seeing a moderation. And FMCG companies are also commenting on seeing some improvement in demand, although I think I want to say that it's a structural issue. I think it's more of a cyclical issue, and we have seen this earlier times. In fact, there were times when it was reverse as well. Rural was doing much better while urban was struggling. I think these are cyclical elements, and they tend to, reverse automatically with a period of time.
Thanks, Vishal. Vishal, if you can take one last question quickly, so before we conclude. So, in UTI Focused Fund, so what is the time horizon that you typically recommend for the investor, and also its suitability?
See, it's like any other diversified equity fund which we recommend. I think you should at least come with a time horizon of at least 3 to 5 years, if not more. It's like any other diversified equity fund. The only difference which I explained is in the number of stocks. So the standard horizon which we expect for any, and we have enough data to see that as you keep on increasing your time horizon, 1 year, 3 year, 5 years, 7 year, 10 years, the probability of making negative returns or the probability of making more than 8% returns actually disproportionate and keep on increasing. So I think 3 to 5 years is the bare minimum one should keep in mind while investing in any diversified equity fund, UTI Focused Fund being one of them.
Sure. Great. Thanks, Vishal. I think with that, we have reached towards the end of today's webinar. So thanks, Vetri and Vishal, for sharing your insights, and also viewers for your active participation by sharing the questions. And if you have actually missed any part of this webinar, so and wish to view the same, the recording of this webinar will be available on our YouTube channel. So you can visit our channel and view the webinar anytime. And finally, a request to our viewers. So please use the feedback link which is available on the screen to share your feedback on today's webinar. It will be thank everyone and have a good evening. Thank you.
Thank you, everyone.
Thank you, Niranjan. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.